When a brand comes to you and is like, hey, Dylan, we want to crank up ad spend. How do we think about forecasting what our CAC might be at different ad spend levels? What are the things that brands have to think about there?
To some degree, it's an analysis of understanding, like, as you plot ad spend growth over time, what happens to the core metrics that you're actually tracking and seeing, and how much, like, how linear is it, so to speak. And different brands have different realities when it comes to that. But there's also a big piece of this too that is seasonality. Like, we see this with some
Yeah.
brands where there's just certain months of the year where the incrementality of spend is so high that you're just so incentivized to really focus on that. So there's another piece
Yeah.
of it too, where it's not just like you can plot any time period and assume that to be the reality forever. It's also understanding that different moments are going to kind of flex TAM up or down to allow you to potentially go bigger without having the potential negative repercussions.
Welcome back, everyone. Episode 3. Dylan, how are you,
Talking
man?
about ad spend and profit margins, the good stuff, the good stuff.
Yeah, how are profit margins going to change as we scale ads? It is the $1 million question that we get asked all the time. To set the stage really quick here. Yeah, I got somewhere on this desk, and I got an abalone shell, no crystal ball. I don't know if that'll do the trick. But look, set the stage really quick, and then we're going to dive in. I think, and I'm curious to see if you agree with this, from the CFO perspective, and what we see ecom brands ask us about all the time is that they want to know how their profit margins are going to change as they scale. And some founders don't understand how CAC is going to change, and maybe even more importantly, how new customer versus repeat customer revenue mix is going to change. And they want to scale, but they get really fixated on just ROAS, like full funnel ROAS or blended company ROAS. And they don't realize that that's going to change because there's some underlying drivers of profit margin that are going to change. And we need to help them break that down. Do you agree with that framing?
I do agree. I'd say that, like, on the top, before we kind of jump into like new customer versus return customer and how that can change over time, one of the big ones is also just like OpEx and how that changes over time. Because
Yeah.
ideally, as you get bigger, that number as a percentage goes down and down and down, which does allow you to have like lower full funnel ROAS or lower MER, however you want to categorize it. And that's like a relatively simple thing to think about because a lot of your costs ideally will be fixed and don't scale linearly. But then when you go a layer deeper, that's when you just start thinking about the new versus return customer piece. We have a few ways of thinking of it at Aplo. It's a little bit different brand to brand, and I'm happy to kind of dive into some of the nuances there. But curious on your side, John, if there's any like particular starting points that you take when thinking about this problem.
Look, more and more, because we're talking about scaling, right? We're talking about in the context of scaling ad spend. So yes, fixed OpEx planning is important, but it's secondary, generally speaking, to planning out how margin dollars, where we kind of start is what are the margin dollars being generated by new customers and the margin dollars being generated by repeat customers, right? That's the starting point. We then go connect it to inventory management and fixed overhead dollars by month and various other financial metrics. That's also why we love partnering with you guys, because we meet at that point with you guys, right? Like we meet at the intersection of free to grow and Aplo is new customer contribution margin dollars versus repeat. And then we have our respective areas that we specialize in and support one another. But yes, that's the starting point as far as we're concerned in the context of scaling ad spend. Right. So really quick, before we dive into those two streams, because this is the thing we get asked about all the time. CAC changing as you scale ad spend, right? I know you guys got a crystal ball over there and you can just forecast it perfectly. No, I'm just kidding. What are some, okay, because we can't forecast it perfectly, but it is one of the more important, I would say one of the most important like metrics to think about related to profit margin that's going to change as you scale. When a brand comes to you and is like, hey, Dylan, we want to crank up ad spend. Like, how do we think about forecasting or planning what our CAC might be at different ad spend levels? Like, what are the things that brands have to think about there?
Yeah, so it really depends as to where you're at and the mix of the traffic pie, because the more acquisition sources you have going on, the harder it gets to like effectively measure all of them, in my opinion, and it creates a level of intricacy that is higher than a single channel or single like advertising channel store in terms of forecasting that new customer revenue growth over time. And like I think that when we talk about this, we're talking about it in the sense that ad spend meaningfully impacts first-time customers. And the truth is it also has some impact on returning customers over time too. But when we're talking about growth and thinking about scaling spend, normally we're talking about it in terms of like growing the new customer base. Like to some degree, it's an analysis of understanding like as you plot ad spend growth over time, what happens to the core metrics that you're actually tracking and seeing, and how much like how linear is it, so to speak. And different brands have different you know just like realities when it comes to that, and kind of getting in there and understanding over the first couple of months of doing a forecasting exercise how that kind of behaves as you try and scale spend is really where you get a lot of those initial learnings. But there's also a big piece of this too that is seasonality. Like we see this with some
Yeah.
brands where there's just certain months of the year where the incrementality of spend is so high that you're just so incentivized to really focus on that. So there's another piece
Yeah.
of it too, where it's not just like you can plot any time period and assume that to be the reality forever. It's also understanding that like different moments, be it that you create with your marketing calendar and or just like the seasonal realities of the products you sell are going to kind of flex TAM up or down to allow you to potentially go bigger without having the potential negative repercussions. Those are some of the initial kind of frameworks we use for thinking about it. Additionally, there's also a relationship between first-time customer and return customer and how that behaves over time. But yeah, that's like generally where we will start. What are your thoughts on that?
Yeah, no, it makes sense. And I mean, people are going to hear this a lot listening to this show, but like there is no crystal ball. It's a statistical analysis to project where it might lie in the future based on historical data, right? And so I just want to always, this is Mr. CFO talking here, right? So like a lot of CFOs like to think that they're going to give you the perfect answer. We at Free to Grow don't give you the perfect answer. We give you the scenarios, we give you a range of possibilities, and we forecast them out on the P&L and the balance sheet to say, if this were to happen, what will we do? If this were to happen, what will we do? If this were to happen, and then we use historical data to give us a range of what we feel like is probably reasonable, right? Of where things could lie. And so from a CAC perspective, from like how CAC's going to change as you scale ad spend, and CAC being one of the core drivers of new order profitability, right? We always like to ask you guys. That's why we hope that we're working on a brand mutually with you guys, because that base of mutual customers is growing. And so we have a lot of open communication lines about this kind of stuff. But it's like, we really like to rely on the ad agency to be like, where do we think CAC could lie? And again, not holding their feet to the fire and saying, what is CAC going to be, right? But what could it be and why? And again, as time goes on, we're all learning about that particular brand. Like I've actually seen you guys work with brands before where you start and I look at their historical data and you guys scale ad spend and CAC goes down. And it's probably because you're fixing a bunch of other stuff in the funnel at that time, right? You're optimizing emails, you're fixing stuff on site, but you don't expect that to go forever. At some point, if you're continuing to scale, you will see diminishing returns and CAC will go up, right? And so besides CAC going up as you're scaling ad spend and that putting more pressure on first order profit margins or new customer profit margins, what are the other things you guys see changing about profit margins as you continue to scale?
Yeah, so like ideally over time, if you have high LTV, you see that return customer base continue to compound. So if you do see some attrition and acquisition, ideally there's some supplementary LTV growth that helps kind of manage that in terms of like the percentage of profitability. But it's kind of a balance because depending on what you're targeting as a business, be it like profit dollars or profit as a percentage, when you go and acquire customers, there's generally going to be that over time you see that margin kind of decrease. And let's say for a simple example, let's say you have the target of doing, I don't know, 25% contribution margin store wide across first time and returning customers, but you're only getting 10 to 15% contribution margin dollars on those first time customers. You're going to reach a point where your return customer revenue growth will set a cap on how fast you can actually scale, because you have to have that relationship of waiting for that return customer revenue growth to allow for, your to kind of catch up with your growth so it averages out to like the store-wide average you want. And in that
Hold on, let's
situation,
stop there. This is a big one. Hold on, because we've been talking with our clients a lot about this. In
yeah,
fact, I think in episode 2, I told a story about a brand, a CPG brand that I'm working with. And this is, I would say, this is, if there's one thing everyone can take away from this episode, it's this balance. It's to stop. You need to measure company-wide contribution margin. Okay. You should measure that as a ratio of revenue and you should measure it as dollars. But then you should go one level deeper and you should say, what are my contribution margin dollars and ratio for new customers versus repeat customers? And how is I always like to use, I use this concept of, I call it the repeat purchase subsidy, right? The formula is, and Dylan, you can tell me if you like what you want to add to this or if you disagree at all. From a CFO, the way that we view this as CFOs with helping brands manage their P&L as they're trying to scale ad spend, the formula is take repeat purchase margin dollar subsidy, put some of it back into losing money or turning a smaller profit, right, on new customers. It could still be positive, but putting it back into the ad spend to either lose money or turn a smaller profit, but leaving enough of that repeat purchase margin subsidy, leaving enough of that in the business to cover overhead and still produce a profit, bottom line. You can take all of it if you want, right? But if you take all of it and you let new customer acquisition deplete all of it, you'll turn a loss on the balance, or sorry, on your bottom line P&L. Maybe you can choose to run break even if you want and just retain and not invest your fixed overhead cost amount, but that leaves nothing left over for cushion and, like we talked about in episode 2, being financially resilient. But that's the cycle. It's like get repeat purchase margin dollars invested in lower margin new customers. But when you think about that relationship, if that bucket of repeat purchase contribution shrinks, right, in any given month, there's not as much to then take, cover fixed overhead, drop some to the bottom line, and then put some back into new customer. So it's more of like a seesaw balancing act, right, of those two streams. There are other tools we use, like looking at cohort, and now like cohort models are a way to show the relationship between the first order and follow-on orders. And there are some other tools that we use at Free to Grow to help you think about how those things are changing historically, but none of them in and of themselves are crystal balls. They're models to think about how ultimately repeat customer contribution margin dollars are coming into the business and being used to cover fixed overhead profit, and then whatever amount we feel comfortable with, we put back into new customer acquisition. What are your thoughts on that?
I think that makes total sense. I also think another way to think about forecasting is it's like a series of scenarios so you can plan if statements around them. And then
Mm.
also it's an exercise in like assigning confidence to a forecast to dictate how much you're willing to bet behind that either happening or actually doing better than what you have forecasted in some ways. Because if you think about, we talked about resiliency in like the last pod, this pod, how does resiliency impact like your ability or willingness to kind of, have high confidence in your forecast? If you're like very, very like slim margin first time customer dependent, it does not take much for you to be wrong, and that and then you being wrong requiring you to do something way different than your
Mm.
base case forecast. If you are first order profitable, have high LTV, and are reasonably good at forecasting, even if you're underperforming to KPI, there's a good chance that you can probably still come in around or near your forecast if you're willing to be somewhat flexible that month in terms of your contribution margin outcome, because the risk associated with doing so is maybe not that bad. If you have a lot of contribution margin dollars left, you're just going to have a little bit less to work with that month. And then you also have the ability to kind of underwrite that risk better via the return customer revenue growth you're going to have over time. So at Aplo, we tend to like find it a lot easier to forecast growth for high LTV businesses because as you think about risk planning and scenario planning, there's usually a higher band of what would be deemed like a good outcome.
Yeah.
So your band of scenarios are more likely to come true. Whereas if you're first time customer dominant and relatively slim margin, all of a sudden, like your one scenario is like you're just cranking spend as much as you can because you're creating those first time customer contribution margin dollars. And the other scenario is like you're just not. And you may have one scenario that's legitimately almost like twice as high one month as another month as you're kind of riding the wave of that first time customer acquisition. And for better or for worse, that's just a way more volatile business and one that's way more difficult to forecast. And when it's way more difficult to forecast, that has a ton of knock-on effects, be it like how you plan your inventory, et cetera, how you plan cash flow. So generally speaking, over time, you're going to ideally have that return customer revenue growth in any business to hopefully kind of help manage the risk as you kind of think about some of these forecasts. And even in the extreme cases, you can have kind of like the extreme upside and the extreme downside. Generally, you're going to have like more accuracy in our experience forecasting high LTV businesses, or maybe more accuracy is the wrong word, but more confidence in the range in which you think you may fall at the end of any given period.
Okay, so I'm putting my like CFO investor hat on, right? Because like one thing that we do as CFOs, it's really important. One job of a CFO, one really important job of a CFO is to be the chief capital allocator, right? What does that mean? It means to make sure that the capital that is available to the business, that it's being allocated to the best like ROI areas that it could be allocated to, right? But a part of capital allocation is what is the risk versus the certainty or uncertainty of the ROI that you're forecasting. That's just like a general corporate finance or investment like kind of heuristic to think about in your head, right? And so when you think about scaling, I think a lot of brands, like this is how I thought, to be clear, 10 years ago when we started Guardian Bikes, we just thought that you start a brand with a product category that has like a ton of TAM on D2C and you like figure out how to spend on ads and you kill it. And maybe back then it was more like that because there's a little bit more of a blue ocean, right? I don't know. But that being said, in reality, as I do this more and more and Free to Grow advises more and more businesses and we get more reps under our belt, it's about being an investor when you're thinking about your business, right? Like being investor minded. And what are investors always thinking about? Risk versus return probability, right? And then the cost of capital or the opportunity cost of capital, which means if you put $1 somewhere, it's not available to put somewhere else. So in the simplest terms, what investors or really good finance people are supposed to be doing is going, here are all the risk return pairs of all the places where this business could use money, right? And I'm going to help go from best risk return pair to worse until we have no capital left to allocate. So I just want to start with that framing. But as you were talking, I was thinking in those terms and going like, you're talking about LTV. I just kept hearing in my head a cushion, right? There's different cushions. What is a cushion, right? In terms of what I'm going to explain, it's a risk mitigator, right? So you can have a capital structure cushion, which means you can have a cushion of equity capital on the balance sheet. That reduces risk, right? What you were just explaining from a finance perspective is there's this cushion of repeat purchase contribution margin dollar or lack thereof that makes scaling more or less risky, right? And so when if you have little to no, I just call it, you may have repeat purchase, but it's not meaningful. There's not a meaningful number of contribution margin dollars that come from repeat purchase. If you don't have meaningful repeat purchase, you have no LTV cushion, right? That makes scaling riskier. Does it make it impossible? No. It makes it riskier, right? When you have an LTV cushion or you have a balance sheet cushion of cash, those are examples of having risk mitigation strategies. And I'm saying this for a reason, because when you have those cushions, you may be able to, on the new customer side of your business, push harder because you've got a cushion sitting over here. So this is not a game of I launch this product, people like it, I spend ad spend, I scale it, I crush it. This is a game of risk versus return. And when people ask me, Jon, how fast can I scale and still be profitable? The question is, how much of these cushions do we have? Do we have cushion in our gross margin dollars per order? Do we have cushion in LTV, in LTV? Do we have cushions in cash on the balance sheet or capital flexibility? So I just wanted to say that because like That's what I'm hearing from a finance perspective as you're going through that.
Yeah, I totally agree with that. I think that you know, like I think that too often brand owners don't think of their POs as bets or their like spends as bets. And you're trying to basically go and get a return on that capital spent. And there are just some businesses or some like product lines that will just have better risk adjusted returns. And it's just like a no-brainer. And the cushion analogy, I totally agree with that as well. I think that there's multiple types, and you just want to make sure that you ideally have a few if you're going to go and try and make a few big swings.
So I'm curious, like we talked about this a little bit before we hit record, but when a brand, we've kind of set the stage at a high level about how to think about new versus repeat margin dollars and how they can impact profit margins as you scale ad spend. But when a brand comes to you and says like, hey, Dylan, these are our goals. We want to scale this much. Like, walk me through a little more specifically, like some of the reports and data. Like, let's get a little tactical here. Like, data do you guys start looking at to help them assess how fast you think they can grow and manage their profit margin?
Yeah. So like oftentimes there's going to be some sort of top line revenue volume goal. And say like maybe a brand comes to us and says, "Hey, I want to grow 80% this year. That's my target. And I want to do it with X% margins." And we'll basically say, "Okay, sounds good." And we'll basically try and work backwards from if you want to go and do that volume number on top line, what do we think your bottom line would look like present state if you were to basically just extrapolate what we think your new customer ROAS would be over time by month. Then from there, understanding from every subsequent month how many of those initial cohort customers are going to come back and purchase, as well as all of your historical active customer base, to understand like what your contribution margin and or net margin would be over time. And then we'd be like, once we get to that point, we're doing that 80% growth, but maybe we're beating on efficiency, or maybe we're not, and we're actually lower on efficiency. And then it's a conversation of if it's lower or higher, I guess. It's like if it's higher, do we want to go
Yeah.
into more volume because we think we can actually beat on the efficiency side? Or if we're missing on the efficiency target, how much are we missing by? If it's relatively like minimal, maybe we say go for it anyways. Or maybe it's like, well, we either have to re-underwrite our expectations for top line growth, and maybe instead of 80%, it's, I don't know, 65. And we can aspirationally go and say, hey, our current expectation is 65, but we want to get to 80. And here's all the different things we're going to try and do to increase the probability of us getting to a place where that's potentially an achievable target. Normally, the way in which we kind of operate is like first meeting of every month when we're doing some of these like growth planning activities is reviewing the prior month actuals compared to forecast, what we think the next month will be. And then depending on the client, maybe we're forecasting 3 months into the future, 6 months into the future, 12 months into the future. It can range depending on their needs and kind of goals and etc. But usually it's working backwards from what is your goal? What do we think it looks like to get there today? And then is that a financially viable place to be? And then discussing and reaching some agreement of like, this is what we think is possible. Let's target that and then understand what we need to do to actually hit that target by month and what we think is possible in order to get to that place. So that tends to be the workflow. It can vary a little bit brand to brand. It also depends how much data you have historically, how much advertising data. Like most of our clients are very paid acquisition heavy. If you're not paid acquisition heavy and you're organic heavy and you're for whatever reason stagnating, there may be a period of time where we need to get more data to actually make more informed decisions, or not more informed decisions, but just being more informed to build a more
Yeah.
accurate forecast. But yeah, I'd say that's generally the workflow. And that conversation that we would have about goals and targets, it's like, is this even a viable goal? That can be a difficult conversation to have because, like people have goals for a reason. They want to go and achieve something. It becomes a very collaborative discussion around what we think is possible and what we may have to do to go and get to where we want to go. And then, it's great when we think there's actually higher upside than the brand owner themselves was thinking there was. That's the ideal outcome. It makes for a very great conversation, but there's a little bit of everything.
Yeah. So from a financial planning standpoint, like from a planning best practices standpoint, because we're obviously financial planning experts at Free to Grow, planning, there's this planning from top down and then bottom up, right? Top down is thinking more of like goals, right? Strategic direction set by ownership and executives. Bottom up is, does the data support it? Like, what would we have to do bottom up on the KPIs to get to this number? And that's where you determine feasibility. I always tell brands that I work with, like, hey, the bottoms up forecast is not a prediction exercise. It's a feasibility exercise. And it's more, if anything, it's a projection. We'll get to this in a second, the difference between a projection and a forecast. I was just defining this for a client last week. It's a projection of what activity levels would have to be true for your top-down outcome number to be a reality, right? And so I was working through this with a client who's struggling right now to hit their goals. And I've been encouraging their VP of growth to do these bottom-up forecasts, not because we're guaranteed to hit those numbers, because it tells us if we did hit these leading indicator, right, KPIs, what would the lagging indicator, in this case, profit and bottom line profit and top line revenue, what would those lagging indicators be? And because then the next question is, what actions need to take place, right? What activities need to occur for these leading indicator KPIs to hit these activity levels, and what resources, who's going to do them, right? That's really what we help with a lot on the financial planning side, is like, take the revenue forecast and the ad spend forecast. And again, one of the reasons we love working with Aplo is because we get the breakdown of what your assumptions are on the new customer versus repeat customer side of things, which exists in our revenue builds in our 3-statement financial models. And then we're sitting down with the team and saying, what, besides the ad agency, in this case, Aplo, like, we know what they're going to do. What do you guys need to do? What do you need to do to keep up with creative? What do you need to do to keep up with inventory? What do you need to do to keep up with production? We're taking those other inputs that impact other areas of the P&L and the balance sheet and the cash flow statement, and we're putting those into our financial model. And then we're helping them assess feasibility of ultimately supporting what the growth team's efforts are, right? And that's where you come into this holistic planning exercise of saying, it's not planning does not exist to say we're going to hit this number. Planning exists to say, based on these models, we would have to execute all these activities, right, to get to these numbers. And that's where the value is.
I agree. I think that, like, back to like what you can do about it part, when you're building an initial forecast, you're basically looking at your historical acquisition trends, you're looking at your cohort retention rates and how many customers you expect to come back over time, adjusting for seasonality. But then what are the two levers you can ideally drive from like a marketing standpoint is that return customer revenue and that first time customer ROAS outcome. And when it is possible to impact that retention piece, it's usually lower hanging fruit. The ROAS outcome on ads is usually harder, especially to like kind of construct on a shorter term time frame. But that's going to be either like some mix of like better media planning and media buying mixed with more creative, nowadays creative mattering more and more. And on the email and SMS side, like, is there any just low-hanging fruit in the account that ideally you can meaningfully improve return customer rates over time via better post-purchase strategies, campaign strategies, etc. And then also understanding, like, if you're going to miss some sort of target you hit or you think you're going to miss, how do you adjust in real time on the marketing side? Oftentimes this is more so done on email and SMS to either just send more volume and or run like a last minute flash sale or some sort of event you can create to increase the probability mid-month of getting to the outcome you're trying to drive. So I think forecasting is great and you can do it all day. But you said this earlier, is like it's like to have a direction you're going in, but A, being willing to change the forecast if something changes, or B, actually making tactical implementations to increase the probability of you actually hitting that target mid-month is like arguably the bigger part of it all as well.
Totally. So before we end in a couple minutes here, I want to tell a story so we've been talking about how new customer versus repeat customer, like balancing those revenue and ultimately margin dollar flows is the big way that you manage margins as you scale ad spend. But I do want to tell a story about the reality is that, like, tactically, you do what you can in any given month. And sometimes what you plan is not what you end up actually being able to do. And so Aplo and Free to Grow have a mutual client that I'm thinking of, and we set a plan for the month of February We had a plan for what the new customer contribution margin dollar outcome could be and what the repeat customer contribution margin dollar outcome could be. Embedded in that yielded an ad spend plan and a new customer ROAS plan, and ultimately a blended or full funnel ROAS plan, because we had an assumption of what repeat customers would be. Now, we've already aligned as a team, right? A cross-functional team between our finance team and Aplo's marketing team and the client, that we're not going to run this brand at a contribution margin dollar loss on new customers, because the repeat purchase profile, you look at their cohort data and you look at some of the other historical repeat, they have repeat purchase, but it's not structured in a way that we believe is healthy to, or we don't believe it's healthy to lose money on new customers. So we've kind of set this constraint of, we want to at least break even on new customers. As Aplo is scaling towards the goal for the month, we weren't too far off on the blended full funnel ROAS, but we started seeing, and Aplo is seeing, we're starting to lose money on new customers, right? So we pulled back. I mean, you guys pulled back, but I'm saying we, because we're on the same team. The ad spend got pulled back, and we got pretty much break even on new customers, and we didn't hit the ad spend goal for the month. We were pretty close on the full funnel ROAS goal. I think we were actually pretty much right on. But I was confident as the CFO, saying this move actually protected contribution margin dollars, and we actually made more contribution margin dollars by pulling back ad spend than if we had kept going. Contrast that with an agency that this brand worked with a year ago. We just gave them they operated on just ad spend and full funnel ROAS target. They would have just been cranking spend up and down, trying to figure out how to get as close to that ad spend goal and full funnel ROAS, instead of looking down at new customers versus repeat, which allowed us to decide it's better to just keep new customers break even and let the profit come from repeat customers. So I just wanted to tell that story, because in that month we couldn't make it happen, but in March we're blowing past the goal, because new customer profitability was there, and so was repeat, and there was room to scale. So we took what we could, and Aplo has scaled way beyond the goal, and it's going to end up being net better for February and March combined. So that's just a little story of how you can manage your profit margins better, right? If you work with an agency like Aplo and a DTC fractional CFO firm like Free to Grow, where we can help you make better decisions to manage your profit margins as you're scaling. So unfortunately, we got to cut this one off because we got some client meetings to make it to. But this is an awesome episode, and I'm already looking forward to episode 4. Yeah, man, let's keep it going. Ecom Scaling Show. Let's go.
Yes, sir.